There's certain rules in the SBA, and everybody has to play within those rules, right? Like you might get up to bat, you might not like that you only get 3 strikes, but that's it. You get 3 strikes and you're out. So with the SBA, it's very clear with what the rules are, but there's a lot of interpretation that goes into, the 800 pages that are in the SBA SOP. There's just a lot of ways that banks look at things differently. And the SBA, I think, gets somewhat of a bad rap because people will call me and say, oh, I understand the SBA says this, this, and this. And I'll say, no, that's what the bank is saying.
Yeah. So, Bruce Marks, First Bank of the Lake, is that right? First Bank of the Lake, Senior Vice President, a fellow M&A pro. We did our certification in mergers acquisitions class together, which was, I think, 10 years ago.
It was.
In Chicago.
DePaul University.
At DePaul University, right? Which was a great week and a great facility there. I don't know what I was expecting out of that, but it definitely exceeded my expectations, and it was something I felt like I got a lot out of, and it sounds like you did too. So I think you are an excellent guest for the podcast because you're a guy that is really at the forefront of SBA business acquisition lending in the U.S., right? You've done, the last count that I have, and this may be like the McDonald's hamburger count, it's wrong by now, like they have to change the billboard, but 1,200 SBA transactions across 35 years. And did you say $500 million?
Mm-hmm.
Yeah. That's
over the last number. 10 years.
Oh, yeah, and that's a huge number. By the way, First Bank of the Lake, which lake are we talking about?
So it's funny you ask that because everyone says that, right? Which lake?
The lake.
Okay, the lake.
Many lakes.
So it's actually on Osage Beach in Missouri.
Familiar with it. Okay.
Yeah, so that's where it is. And it's kind of considered like the Lake of the Ozarks. So it ties in Kansas City and St. Louis and goes up through there. So it's actually on the lake. And that's our main office and our one branch.
Oh, really? And then, so you're here, you have an office here, and you're in South Florida here,
right,
where I am.
Correct.
And so they don't have a branch, it's just a lending arm, or?
Right. So we work basically remote, right?
Remote, okay.
Right. So I've got several folks that report to me, and we have other verticals, and we've got some folks here in Florida, and then I think we now have like 263 people in our SBA division. They're spread all around the United States. So.
Yeah. And so I would imagine nationally, obviously you do a lot of volume, but I would imagine nationally you guys do, some multiple of that more.
Yeah. So the SBA, the way they rank it is their fiscal year actually starts October 1. Mm-hmm. So it's not on doesn't end in December. So I think right now we're ranked 15th or 16th top lender in the country. And we came from, just now, I joined in January of 2020, right before COVID. Mm-hmm. And, we weren't even on the map with SBA. And, over the past 5.5 years, we're now, a top tier SBA lender with a terrific group and a lot of folks, and helping a lot of small businesses get financing to grow, to acquire, to buy just all the different uses with SBA proceeds. Yeah,
I mean, I think that's great. And I think it's one of the things that seemingly makes us pretty unique as a country is that a program like this that allows people to, the 7A program, right, is the primary business acquisition loan, which I was probably fairly ignorant on for many years until, like I told you recently, we've done a number of them, working with clients who have utilized the loan program, and it's amazing what they can do. Would love to hear a little bit more about what you think the highlights are of the program that most people may not know about.
Its ability to get access to capital. Most small businesses, when they go to a lending institution, the word collateral comes up.
Yeah,
right?
Sure.
What do you have as collateral? What can we use? God forbid the loan goes into default. Well, in the SBA's thought process, it's all about cash flow. So SBA is a 100% cash flow lender. And it will say in the SBA SOP that if the business has plenty of collateral but insufficient cash flow, that the lender should actually decline the loan, because they want to stay that cash flow is king.
Yeah.
Cash flow repays. Yeah. You don't want to look to liquidate your collateral to try to make yourself whole. So I think the uniqueness of the SBA is several things. It's a program which allows longer terms, so it provides easier repayment. Mm-hmm. If you go get, as you know, a conventional loan, let's say for an acquisition transaction, it might be 5 years, maybe 7 years, depending upon, again, the assets, the collateral behind the deal, right?
Right.
SBA is 10 years. So if you take, $1 million payment and you amortize it over 5 years versus 10 years, right? It's a definite drain on cash flow. It makes that deal much, much tighter, right? So the length of the loan is a big reason why people turn to the SBA. Obviously, as a cash flow lender is another one. They're not reliant on collateral.
Yeah, right. Especially in a service-based economy, right? Like how many businesses have enough collateral to justify.
And then, the SBA allows certain, for example, on business acquisition, it's a 10-year loan. But if you're doing tenant improvements, they'll give you 15 years to do that, right?
Okay.
You're buying real estate, they'll give you 25 years. So you can get a loan and you can blend the term.
Yeah, right.
And pull out that amortization even longer, which makes the program super attractive. And then the main thing is in conventional lending, the down payment. Right, as a conventional lender, you're looking for a much larger down payment with SBA, depending upon how the deal is structured. If we're doing an acquisition, the SBA requires a 10% equity check into that transaction, but the seller can hold a piece of it as long as it's on standby for the life of the loan to act as a portion of that equity. So essentially you can get 95% financing.
Which is amazing.
Which is amazing from a leverage standpoint, as long as you're buying it at the right multiple, right? You can't lever up on a 5x plus, but you can lever up on a 3x.
Which a lot of businesses that works.
Right.
You got a retiring owner, and that's kind of what the market bears. But I was amazed when I learned of that, and I think the ability to be able to do that if needed, and if the loan cash flows and underwrites, then what an amazing option that is for sure. How did you get into this?
I was working as a conventional lender, so I was a commercial lender, and I had a portfolio, and I was a relationship manager. And the bank that I was working with at the time, it was a very small bank down in Dadeland, in Kendall.
Oh yeah.
So trekking down south. And because of our size, we were doing participation loans with another lender.
Right.
And back then, there were only 2 preferred lenders in the state of Florida at the time. Only 2, imagine. This bank that we were doing participation loans was one of them. So as I started working closely with that bank doing participation loans, I became friendly with the senior lender of that institution. And one day over lunch, he said, we've got a unique program here at the bank. We utilize the SBA 7A loan programs to make loans to help small businesses. Now back then, Russ, you have to remember, the maximum was $500,000.
Oh, wow. Yeah.
Right, a lot different. It's 10 times that now, obviously, $5 million. So $500,000. I mean, it was really small business lending, right? And he said, we have an office. I was driving down to Kendall every day, and I lived in Plantation. So it was a far commute for me. He said, oh, by the way, we happen to have a branch in Plantation, and we're looking to expand. Might you be interested? That was a very easy yes.
Yeah.
And he said, and we're going to put you into our SBA group, and you're going to learn, how to lend through the government under the SBA 7A program. And that's how I got into it. And you have to have a lot of conviction to work with small businesses. And I was always an entrepreneur at heart. Grew up, my dad had his own business.
Yeah.
So I knew I had that conviction to do it. And so it was just a great fit. And that's how I got into it.
Yeah, that's great. Well, 1,200 transactions later, I thought this was an interesting question, but from all the transactions that you've been involved with, is there any one that stands out to you as something that you learned from, maybe more than others?
Yeah. And I had tweeted about this as well, so it's a story that's out there on the internet. It's not my deal, but it's the deal that unfortunately has been the most impactful for me as a lender. A colleague of mine had made a loan to a gentleman to buy a business. The gentleman was buying a business that he didn't really know a lot about, unfortunately.
Mm-hmm.
But he had a good relationship with the seller, and he had so-called transferable skills, which were questionable,
Debatable, yeah.
debatable. And the seller was older and did not want to take a note. So the buyer put in the required equity injection. This goes back several years. And the transaction closed. When the transaction closed, the transition plan was for the seller to assist the buyer, introduce him to the clients, provide an expertise in management that he could, as the previous seller, provide. And that Monday, after the loan closing rolled around, the buyer called up the seller, and the seller said, "I've got deal fatigue, and I'm not going to be able to come in. I need 2 weeks I'm going to go on vacation. I'll come back in 2 weeks, and we'll get the ball rolling." The 2 weeks go by. The buyer calls the seller, "Hey, looking forward for you to come in to work on Monday. Reach out, let me know what time." And unfortunately, the seller did not show up. And another week passed, and another week passed, and the seller just went dark on the new buyer. And the new buyer had the business for about 4 to 5 months, and then he lost it. He not only lost the business, but it created havoc in his personal life, as one could imagine. Because he had invested, the business wasn't working, he was taking money out to try to keep it sustainable. It was creating a tremendous amount of friction between he and his wife. Unfortunately, he had pledged all his assets as collateral to try to make the deal work, and it didn't. And it turned out as bad as you can imagine.
Wow.
I remember being in the bank's office in Chicago, not my current employer, and was sitting there when we got the call from the wife, because we were trying to see what happened, collect any collateral, go after the loan. And she unfortunately had relayed the news that it was too much for the gentleman to handle, and he had taken his life. And it's a sad but true story. But what I learned from that whole experience and being an observer, if you will, and trying to look at what went wrong, why it went wrong, where the engagement was, that controls a lot of my thought process today when I look at a transaction. Because when we can't predict the future, as you know, we go in, we try to...
I say that a lot, by the way.
We underwrite the deal the best that we can. We try to de-risk the deal the best that we can. We try to put all the levers in place, make sure that the debt service coverages are there, we're protected, the buyer's there. But you don't know, right? You don't know. But I'm always reminded of that every time I look at a transaction to this day. And the major lesson that I learned is if all parties to the transaction aren't vested into that deal, and something goes wrong, it's easy for somebody to walk if they're not truly vested. So it just reminds me of that. And when I get into deal structuring, I think of that every single time.
Yeah, that is a pretty heavy example, I think. Probably, well, I don't see how you get more than that, but just you see, I can't remember a time when we've ever done a transaction where it didn't seem to be at least fairly crucial that the seller take part in the transition and the integration, and that's something that's always a topic of discussion, and usually it's dealt with either the seller's rolling equity, or they've got some sort of substantial seller note, involved in some skin in the game, right? And so
I think the seller note, an escrow, reps, warrants. I mean, you've got to cover yourself as much as you can, because everybody's thought when they buy a business is, and you have to have this thought, is I'm buying this business here, but I'm going to grow it to here. Mm-hmm. That's the bet. That's why you do it, right? You're not buying it to
clip a coupon, right?
Right? And the bet is on yourself that you have that skill set to do it. But it's a bet. Maybe you do, maybe you don't. Not everybody that buys a business comes out, just doesn't work that way, right? It's like, you're playing blackjack. Not every hand's a winner.
The whole entrepreneurship through acquisition sort of credo is that it is more, at least in theory, it's better odds to buy an existing established business versus start one completely from scratch, right? I mean, that's their credo, and I think that statistically is certainly supportable, but that doesn't mean, obviously, that doesn't come without extensive due diligence and making sure you understand all the risk factors in the business, but also understand, how do we grow it, right? If the seller, a lot of times you hear from sellers, and I would love to get some more feedback from you, because I'm sure you have a lot of feedback or interactions with sellers, whether it's direct or indirect, right?
Yep.
Is, okay, well, if you were me, I'm Mr. Buyer, and you're asking the seller, how would you grow the business? And a lot of times you don't really get a convincing answer, right? It's like, oh, it's easy. I just got tired, or, you just gotta get out there. I was fat, dumb, and happy. And
how many times have you heard, I'm Mr. Seller, you can do this, 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 and this, but I don't have the conviction to do it. I've been doing it for 28 years. I don't want to do it anymore. Really? If you could grow it by another $500 to $1 million and you can get a 3 or 4 turn multiple, you're not going to do that?
Yeah.
That doesn't make sense to me. Yeah. So
I don't relate to that.
Right, exactly.
Unless it was I just didn't have the capital to do, or I didn't want to borrow it and take the risk. Then at least there's some cover there.
Right.
And obviously, if you're a private equity firm, like you're licking your chops, because that's what you want to hear, right? You want to hear that you can grow it, and here's how you grow it. You just need capital to do it. But it's interesting how many times, and I try to coach my sellers a little bit, like, put some thought into this. The buyer's going to want to know how they can grow this business. And if we don't really have a compelling answer, don't make one up. But if you don't have a compelling answer, then it's not going to seem very appealing to them. So,
that's right. Great point.
And so,
because that's what they're buying, right? They're buying that upside, and it's not only the buyer, but in the deals that you work, a lot of time, in the deals that I work on, a lot of times they have other minority owners that they're bringing on, right? So they're raising equity to pull these deals down, the size transactions we work on. It's not like they're coming to the table with $1 million or $2 million of their own.
Right.
They just don't. They've worked to gain that skill set. They're a great operator, but it's not like they were coming out of Silicon Valley, right?
Yeah.
With oodles of money, right? So they're bringing in a lot of minority owners into the transaction. So why is a minority owner involved in the first place? Because he wants an exit at a much higher multiple than he bought it for, and a much higher EBITDA that he bought it for. That's the bet. I mean, that's just.
Yeah, I think the private equity benchmark is, and probably not much different from a private investor, is 3x on your money in 5 years. And that's a lot of growth, right? But
In
that's
SBA,
sort of
it's a little bit different, but that's absolutely
Right.
the right for the space that you play in, for sure.
Right. And so, and I think, I don't know what the average private investor is looking for, but probably to invest in a private company where your money is, considered to be illiquid and unmarketable, you want 20% a year return on your money, right? I would be shocked if you saw many private investors that would expect less than that, unless it was just such a risk, a low risk investment where, the yield was more desirable from that standpoint. But here's one thing I think we share that just seeing in dealing with business owners and acquirers on a daily basis, I feel like gives us some empirical knowledge of what works and what doesn't work. And I've often thought of, and I'm going to ask you, do you feel like with all that experience that you have in dealing in all these transactions and seeing the good and the bad and the ugly, that if, tomorrow you were to step out and acquire a business, you feel like you've got a pretty keen eye for how to do that, how to identify a healthy business, buy it and structure it and close it and operate it, given all of what you've seen over these years?
It's a great question. It's something that I talk a lot with operators about. From a structure standpoint, from a deal standpoint, from looking at it, looking at the numbers, yes. But actually getting in there, getting your hands dirty, running the business, it's a different skill set. It's not just, structuring the deal is one thing to get it to the closing table. But now when you're dealing with employees and their issues in a small business, when you're dealing with supply chain issues, how you deal with that. I literally say this often. I like to eat, but that doesn't mean I can go buy a restaurant.
Yeah, sure.
Right? So I think for me, in where the value that I provide to the marketplace that I serve is helping them get that deal to the closing table, talking about all the nuances. Now, I had my own business for 13 years, so but it was on the financial side, right? And I ran a business, but going in and running a light manufacturing business, I'm a banker. Right?
Yeah. Well,
so I don't know.
I see it
Great
more
question.
like, I think I'm gonna give you some more kudos here, like give you a little bit more credit, but I see it more as somebody like you or I are going, I'm essentially a banker too. I'm just the guy putting the deal together. I'm not underwriting it, right? But I see it more as I go in and I know the first thing I got to do is build a team, right? I got to get the right people in the right seats.
Yes.
And I see the value in that. I see the ROI in ensuring that you're not just hiring your friends or you're not just hiring the first person that's available. You're like, I need an ops guy. I need somebody that knows how to lead people. I need a finance guy, and maybe that would be me in that case, that knows how to handle money, and I need somebody that can sell. My dad used to say, nothing happens until somebody sells something. And he would say that to the support staff, saying, the people out there selling cars on the floor, we need to support them.
That's right.
And it's easy to make fun of a salesman for whatever reason, because I think that's just what people do, but they don't make any money until they sell a car. We need to support them, make sure they have what they need to do that, because these lights don't stay on without it.
Yeah.
There's no paper to push around on the. So I feel like to me that's where I know where my limitation would be. Like, hey, this would be my wheelhouse over here, but let me build a team and put the right people in there, because the businesses that we see that we sell, it's all about talent. Most of them don't have some sort of IP. That in and of itself makes up the value of the business. It's just people. It's great teams that have built great client bases. They've built relationships with great vendors, and they've built a brand. All of those things were the result of collaboration of people. So I feel like in that sense that I could do it, and my guess is that you probably could too. So that's kind of where I was going with that. But not to put words in your mouth, but can you share just how your approach to leadership and conducting business in banking in all your years, has it maybe evolved over the years?
It absolutely has evolved. I remember the first time I got into a leadership role, and I remember very vividly because it didn't work out and I wasn't successful. And a lot of times, just because you're good at something and you get put into a position, oh, he's good at this, so we're going to put him over here. To your point about putting the right people in the right place, I was put in a position of leadership and I wasn't ready for it. I didn't understand what it meant. I didn't understand the difference between being a boss and being a leader. And I think maturity, surrounding yourself by leaders, watching them, what they do and what they don't do, frankly. Because I remember my dad used to always say, you can learn the dumbest thing from the dumbest person, but you've learned something. And maybe it's you've learned not to do that, right?
Yeah, sure.
So I you know, as a leader, we always talk about teams, right? Like getting the right teams in place, saying we instead of I, you know, giving them responsibility, letting them shine, and understanding how to communicate with them to get the message across, to be a leader. Because there's a lot of people that are looking for you to be successful once you become that leader, which, you know, is a daunting task in itself, right? I mean, everybody's looking for you to be that guy. And I think I talk about it with a lot of the young folks that I talk about that think that they're going to come in and buy a business and they've got 64 people working for them. How many people have you managed? Tell me a little bit about your management background. Because it's not just about, well, I have the money to buy the business.
Right. And I want to buy it.
Right. And so I'm going to buy it.
Yeah.
Right. And that's acquired. You have to learn it. You have to experience it. You know, the saying, oh, I wish I knew then what I know now. I always say, you can't, because you haven't lived it.
Yeah.
You don't know. And it's not something that you will know until I think that you get to a position where you have years under your belt to do it. So I think when I think about leadership and I think about the roles that I have now in what it is that I do on a daily basis, mentoring, coaching, facilitating, being there, recognizing that I have to put them before me, right? So if one of my reports calls and I'm busy, doesn't matter. I have to do that, right? I have to. And I think the other thing about leadership is, and this is a key to me, is there's a drastic difference, Wes, between a company that is a good company and a company that is an excellent company. And the difference is a company that's an excellent company never lets the day-to-day operations run it. Rather, it runs the day-to-day operations the way they want it to run. So for example, if I have tasks to accomplish in my role, the outside distractions are not going to stop me from doing that. I'll put my phone on mute. I won't answer emails. I will make sure that I get to what I need to do to be successful in that specific need at that time. I don't let the outside distractions take over my day-to-day. And so for me as a leader, making sure that I set the directions, I set the tone, the day goes the way that I want it to go. I try to communicate that to those that I work with, to bring that to them so that they can understand. And it takes a while to get there. But your day is so controlled and it goes the way you want it to when you do get there.
You know, I talk
Does that
a lot
make
about
sense?
him. Yeah, it does. I talk a lot about him on the podcast here, but Alex Hormozy is kind of a known business sort of, I don't know what you call a pundit or, you know, personality, especially in, you know, Instagram. And I like his stuff a lot because I think his messages are very clear, but he talks about the difference between maker time and manager time. And managers want to meet with people, and makers need time like the time that you're saying to create, what it is, whether you're underwriting a deal or you're creating content or you're out there networking and meeting with people and generating business.
That's
like
right.
if you're in the office meeting with people all day long, whether you're driving the meetings or they are, you can't make. And so he talks about the discipline between, like when he takes meetings, blocking off certain times of the day to where he just meet, but other times where there's no interruptions.
That's
and
exactly
he's like,
right.
when he's doing his podcast, it's an hour and a half or 2 hours at a time. He's like, right now is maker time. Like nobody can take that time away from me because I have to do it. And so that's kind of was in a similar ilk that you were talking about, and working on the business versus working in it. And you kind of touched on coaching and mentoring, but in terms of the work that you do, I'm curious as to the role that you play perhaps with borrowers who are buyers buying a business. And I was going to ask, I don't know if you happen to know roughly like the statistic of how many borrowers that you're working with on a yearly basis are first-time acquirers of businesses. I would imagine it's pretty high.
Yeah,
right?
yeah, it's high.
Yeah.
It's very high. I would tell you, it's got to be at least 80% of the people that I'm working with are first-time buyers of a business. The thought process of ETA, entrepreneurship through acquisition.
Yeah, like are you coaching them to a degree and helping them, look at a loan from the same way that you are, so that they're underwriting risk and understanding risk, even if, right?
Yeah, 100%. Yeah, 100%. The ETA programs that are being taught now at Harvard,
Duke, Stanford,
MIT,
right?
Wharton, Stanford, Kellogg, Booth, Rice. I mean, all Yale,
Yeah.
WashU. I mean, all these colleges that now have these ETA programs that are centered around go out, look for a business to buy, find the equity, raise the equity, and then go get an SBA loan and create wealth through acquiring a business. So the majority of the prospects, I'll call them prospects, that I work with are first-time buyers. And that, so when we talk about it, they'll call and say, oh, Bruce, I got a SIM, confidential information memorandum, and I've got an interest in this deal, and I'd like to talk to you about it and see if your bank has some interest. And I always...
You probably get a ton of that.
A ton of that.
Right.
And I am very clear about this. I say every bank has different likes. So just because maybe I don't like something, it doesn't mean that another bank does or doesn't, right? And it goes the way with the SBA SOP. Our interpretation and the way that we look at it, it might align with another bank, but it might not.
That's a super important point, I think, just to pause on, because I think, and I'm telling you what my impression would have been before I knew more, like what you're telling me now, is that I would have thought, oh, this is an SBA, sort of government-sponsored type of loan. Why, the guidelines are the guidelines, right? And everybody falls in line or they don't. But you're telling me that's not the case, and I think that's a really important nuance.
There's certain rules in the SBA, and everybody has to play within those rules, right? Like you might get up to bat, you might not like that you only get 3 strikes, but that's it. You get 3 strikes and you're out. So with the SBA, it's very clear with what the rules are, but there's a lot of interpretation that goes into, the 800 pages that are in the SBA SOP. There's just a lot of ways that banks look at things differently. And the SBA, I think, gets somewhat of a bad rap because people call me and say, oh, I understand the SBA says this, this, and this. And I'll say, no, that's what the bank is saying.
Yeah.
And that's where a lot of it comes, because I'll get a call, and just a real short, quick, easy, oh, I understand the SBA requires a 10-year lease when you're buying a business. You have to be there 10 years. No, that's not in fact the SBA, they say from a credit decision, if the location is conducive to the success, you surely should have it.
Yeah.
But if it's a warehouse type of business,
sort of
and you can move
commodity
3 doors down and you can get 5 2-year options and you want to move in 2 years, have at it.
Different story.
Yeah, different story. But every bank interprets that a little bit differently. The basics that, hey, if anybody owns 20% or more of the business, you got a personal guarantee. Yes.
Yeah.
Every bank is going to do that because those are the kind of things that the SBA requires. But there's just some gray areas. So when a potential borrower prospect calls me up and wants to talk to me about a transaction, I'm the first one to say that. It's not what our bank likes or this bank likes. What makes sense is the business you're buying, and a key word for me is sustainable.
Yeah.
Because if you buy the business, it's got to be around 3, 5, 7, arguably 10 years from now, you've got a 10-year SBA loan.
Yeah.
But a lot of times I'll say to them, if you're buying a business and the location is conducive to the success of the business, you better not get a 10-year lease. You better get a 20-year lease. Because what happens in 10 years if you want to sell it? And I've seen that.
Yeah.
Where sellers have lost a liquidity event because they didn't have anything to sell because their lease was expiring.
Yeah.
And the landlord was not renewing it.
Yeah.
Right? That's a reality, Wes. So
sure.
Given my years in this business, I've seen pretty much anything and everything. So I rely on all that experience to hopefully provide value to the prospects, be impactful to the prospects. And I have a lot of clients who say, Bruce, if you don't bless it, I'm not doing it. I'm not going to do it. And my average client, I would say average client, we're going to look at, and you know that deals die at 3 times before, they eventually hit the closing table if they do. But my average client will look at 3 to 4 deals together and take a little bit over about a year to where that deal is hitting the closing table. Because it's just to go through the diligence, as you know, right?
Yeah.
You interested in business, you sign an LOI, you hire your Q of E provider, and all of a sudden the numbers aren't as reported in the sim. Whoops, now they want to go retrade. How does that look like? What's the seller going to react? Things like, oh, we're going to put the average of the last 12 months peg working capital, blah, 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 blah. And you leave it blank, and then you go back to the seller and you go, okay, in addition to the 20% note I'm asking you to hold, I need you now to leave $500,000 in working capital on the balance sheet. What?
Yeah.
No, I'm not doing that.
That's my money.
Yeah, my money, right. What do you mean? That's product I sold, receivables that are due me, and I'm going to leave it to you?
Yeah. Yeah, I don't get it.
No.
By the way, when I bought this business 25 years ago, I didn't buy it with working capital.
Exactly.
I gave it to you.
Exactly.
What did you buy it for?
Right.
Well, about 1/10 of the price of what I'm selling it, but that doesn't, pay no attention to the man behind the curtain, right?
Yeah.
But, I think to drill down further on that, Bruce, I think that the inclination is for a buyer who's maybe inexperienced, which is where you come in, is they look at that EBITDA number at the end, or that SDE number, that cash flow number in the sim, and they go, wow, like I can, that's what I'm buying, right? That's what they want. They're buying themselves a job in a lot of ways with this at this level, and they're thinking they're falling in love with that without realizing, well, how sustainable is that number?
So that's when I introduce the J curve, right? And everybody knows about it, and it is 100% true all the time. And the J curve happens not all the time because sales aren't going to grow when you take it over, but maybe there's things that you want to implement to grow sales at a faster pace. Maybe you've got to implement a marketing strategy. You talked about that for you.
Yeah.
And what that takes. It's capital to do that. Maybe you have to put in a new system, operating system.
Yeah.
Maybe you need new hardware. Maybe you need new software. Maybe you need new trucks. Who knows, depending upon the business model.
Right.
So the J curve, most people think, oh, well, the J curve, you're talking about EBITDA going down when we buy the business and then coming back up and then growing. Yes, but there's a lot of reason it happens, but it happens. And so a lot of times it's educating prospects and them thinking that, oh, sure, I've got a debt service coverage of 1.4 times. Maybe that drops to 1.2. And how close are you going to feel at night? Because you know, you own businesses. Cash flow is king.
Yeah.
And you go the way the business goes. Business is going great. Man, you're on cloud 9, right? There's nothing better. This is the best thing. Business is going like this. You're not on cloud 9 anymore, right? Like and it's true. It's just the way it works, and it happens. So it's getting to that point where they have to understand that when they're buying a business, that business is an entity, and that entity is responsible for paying them, responsible for paying the bank, responsible paying the seller if there's a seller note, responsible to pay the landlord, responsible to pay the employees, responsible to pay the vendors, suppliers, the community. There's so many purse strings being pulled on that small business. And so one of the biggest things I explain to people is you better buy something you're going to really love. Because if you don't, when you have all of those pressures coming at you, you'll want to walk. You'll want to walk. And I've seen it where people have bought businesses and then 6 months later say, I'm not sure this is the business for me. So it's having all of those conversations and having all of those years of experience and seeing what works, seeing what doesn't work, understanding what happens when because look, it's sellers that have started the business 28 years ago and are now selling this business. They know more than you haven't even begun. They've forgotten what you still have to learn, right? So they are going to tell you everything and anything, no disrespect. They want to sell their business. Yeah. They want to sell their business, and they're going to tell you it's the greatest thing since sliced bread.
Talk a little bit more about that in terms of specifically some red flags that you may look for or most common in businesses that are on the market, because I'd say this a billion times on this podcast, but a very large percentage of businesses that go to market never sell, right? So
you think about the buyer and the seller, right? So they're going to have a third-party business valuation, right? It's going to be somebody independent that comes, and a person that has no emotional attachment to the sale and a person that has no emotional attachment to the buy, and they're going to come up with the value. And they're going to tell you that this is what the business is worth. Mm-hmm. It might be worth that. It might not be worth that, right? So now you've got to get to that place that hopefully you're offering him something that he'll sell and you're willing to buy, right? And there's going to be this disconnect between the two, right? So you now have got to figure out what that's going to be and all the moving pieces that go in there. And the biggest one, I think, is working capital. Sellers just don't understand it.
Yeah.
I'm sure you've seen it where you're having that conversation with your clients and saying, okay, the business is throwing off $1 million in EBITDA and the seller wants a 5X, so $5 million. But the business needs $1 million in working capital. So you're going to finance that? So now it's at a 6 turn. Mm-hmm. Is the seller going to leave it? So now he's selling it at a 4 turn. right? And you have these value gaps, and that makes it very difficult in my mind, and the biggest reason that I see deals not getting to the closing table.
Yeah. What about, I was thinking of some other, most common red flags that you see in businesses that make them unsaleable. Because to me, it seems like working capital is something that's, I mean, it is what it is, right? Every business needs working capital. It's not so much a red flag.
But I've seen so many deals die. I've had deals
that's interesting.
in closing, ready to close, and the deal die. I'll give you just one quick example.
Sure.
Just to over working capital. It was a business, I won't say the state, but it was a buyer, a very experienced buyer, strong MBA degree, been in the workforce for about 20 years. So he was a 40-year-old gentleman. So he wasn't a young entrepreneur. And he was buying this business, and I'll say it was somewhat hardware related. And they were selling product. So in the LOI, they had put that there will be $475,000 of inventory left with the business, because that's what they were buying as part of it, and then a PEG working capital number. Loan gets approved, we're in closing, we're 2 weeks from the closing, and the buyer calls me up and says, okay, we're ready to do the inventory number, right? So we're gonna hire a team that goes in and counts and makes sure the inventory is there. So he sets it up with the seller, and he says, hey, we're gonna be sending our team in next week to count the inventory.
Probably going on a Saturday or something, right? Like,
right.
Yeah.
Exactly. So the seller says to him, and you can't make this stuff up. You can't make this is real. Remind me of the number that we agreed upon.
Oh man.
And the buyer says, $475,000 in inventory plus this amount of working capital, cash to the balance sheet. He says, I don't think I'm going to have that amount of inventory. So the buyer says, well, how much do you have? Well, we've been selling it off. Of course you have. How much
you read the LOI?
How much do you think you have? You cannot make this stuff up. $125,000 to $150,000, and the buyer goes just like this. No problem. We've agreed on $475,000. So next week, just buy the inventory and make sure it's on the balance sheet. And the seller says, now you want me to spend another $275,000, whatever that number is, and buy inventory and leave it for you? No, I'm not doing that. I'm not doing it.
You need the inventory to produce the EBITDA that I'm paying you the multiple on, right?
Well, there you have it, Wes.
Yeah.
You have just passed the CM&A.
I fully believe the story that you're telling me. Unfortunately, only because I've been there. I wish that I was woefully naive of that.
It's one of the red flags. It's literally one of the red flags, because I have had 12 transactions over the last several years in closing that never closed, that didn't hit the closing table. And that's painful for everybody, because you have real money lost. You have real money lost on Q of E, attorney fees, business valuations, site inspections, attorney, blah, blah. The list goes on, and it's real money left on the table. That is a big red flag, a big one. The other, another red flag, and I'm sure you'll appreciate this, is when somebody comes to me and they say, here's the numbers, it's great, it's off P&L and it's off accrual. That's a real hard one to swallow, because SBA utilizes tax returns.
Yeah.
So I've gotten in the habit of asking my prospects, when you're meeting with the business broker, if it's being listed or if it's proprietary, ask this very simple question. When you provide the tax returns to me to give to the bank to underwrite the transaction, how closely will the numbers on your SIM relate to the numbers on the tax
Yeah.
returns. Major red flag. Because a lot of, here's the thing you have to understand. Very, very important point. Sellers are trying to minimize their tax liability. Would you agree?
Of course, to a fault.
Buyers are buying EBITDA. The more EBITDA, the more you get for your business. But there's an odds because the seller says, I'm showing $34,000 on line 21 as net income, but my SDE is really $800,000. That's a major red flag, right? Because we're now relying on all those add backs to get to a business valuation. The thing that I went back to about the business valuation being a big one, it's like a circle. It's like a circle. And that is a major, major red flag when somebody calls me and says, oh, on an accrual basis, they're doing this. And they're off the P&L. And then I get the tax returns and not even.
It's just the same business, right?
Exactly. Yeah. Like I'm up to bat at Wrigley Field and you're trying to catch a ball at Fenway. Like it's like, you know what I mean? It's just like, that is just so different. It's just not. It's not even possible.
Yeah, we try to, one of the questions we get a lot is how soon should a seller call you before they want to sell? Is it a month, a year? And I said, first of all, our first goal is not to get hired on the first phone call. So let's, sooner the better, just to have a conversation. But one of the conversations I have, which is usually just a one-way statement on my part, is as soon as possible, but no shorter than a year out. You got to eliminate the personal expenses through the business. You got to just.
You have to. It's kind of like
3 years.
Putting your house on the market, right? If you're trying to sell your house, oh, maybe you want to freshen it up. Maybe you want to paint it. Maybe you want to give it some curb appeal. Maybe you want to do the landscape, right? Sure. Maybe you want to stage it. Versus just putting it on the market where you walk, the grass is overgrown, there's cobwebs, there's rotten gutter, right? Yeah. So you got to make it presentable, right? Yeah. And so to your point, if you're on the sell side, put the business in a position to sell. Give it a chance to be successful. As you know, just because a seller wants to sell his business doesn't mean it will sell.
It's truth.
It's true. It's true.
You could just go on to Biz Buy Sell and scroll down for days and see cash flow, for hundreds of thousands or millions of dollars, and it's still sitting there a year later. It's not selling.
100%.
There's a reason for that, right?
100%.
And so, it's incredible. We see that a lot. And kind of on a similar note, I wanted to ask you, Bruce, how do you find with such a high percentage of first-time buyers that or do you find that these first-time buyers often maybe underestimate the M&A process and the acquisition process and what it takes to do that, the capital that it takes for diligence, deal sourcing? What is, how are they finding deals? What are you finding that they're doing? Is it networking? Is it cold emails? Is it cold calling? Is it, curious as to what your experience is working with these first-time buyers, how they may underestimate the process, and what might be beneficial for them to know if they're watching.
I think the buyers that I deal with are pretty sophisticated. A majority of the buyers that I work with have very high MBA degrees, and they're being taught that they've got to go out and they've got to get educated about this. So they're taking these ETA programs. There's a ton of folks out there today providing courses on how to buy a business. I know I'm involved with a gentleman, and we run a boot camp, and we do it 4 times a year, 5 times a year. It's a 3-day, very intensive course. He does a phenomenal job. There's a lot of those. There's a lot of folks out there that are providing training on how to buy a business. You can buy courses, right? So the folks that generally come to me are questions more not about the process. So I think that they're not underestimating the process. I think what they're trying to get educated on is every bank's, how they look at the loans, what's their underwriting process. If we have a debt service coverage ratio of 1.5 after tax when we do what we call pari passu lending, does bank B, C, and D have the same criteria, right? And they're relying on, a lot of the time, their minority owners and their experience, right? So if I come to you and I say, hey, Wes, I'm looking at buying a business. I know you're a successful business owner. Can you share with me? So it matters who they're bringing on to partner with, if you will, to buy the business. So I don't see, it may not be a different answer than maybe you expected, but I don't see, from my perspective, a lot of time being wasted.
So they're pretty educated.
They're
utilizing the resources that are out there.
They're relying on the resources, and if they don't, then there's people like me on Twitter or X, which has got such a phenomenal SMB community. It really is. And there's so much out there that they can quickly get the guidance that they need. I just find that in the lower SMB market, everybody is so willing to share. They're not holding things close to the vest, if you know what I mean.
Right.
Oftentimes, if I have, just the other day, I had a client who said, hey, Bruce, I'm interested in buying a business in this particular sector and industry. I said, oh, I've got to hook you up with these two guys because they have already done it, and they will be a phenomenal resource for you. So I just quickly went on X and sent out a quick DM and said, hey, I'm going to introduce you to so-and-so. Would you be more than happy to and I know their answer is absolutely 100% yes.
Yeah, that's cool to see. I've been on, I've seen, by the way, you have a big following on X, formerly Twitter. I think you said you're at 40,000 followers now, which is fascinating. And I see when you tweet, and there's tons of replies and interest, which is cool. So how did that start? And then how long have you been on there?
So for me, I love sharing the story because it's my story, but it's not. In April of 22, I had closed a loan for two partners who bought a turf business in the Texas area. And after we closed, we wanted to do a little bit of marketing. So I called these two guys, and they said, oh, it's funny that you should ask that. We were going to ask for your, back then, Twitter handle and give you a shout out. And I said, not sure what that means, but maybe you can, right, like what? So they said, Bruce, are you not on Twitter? And I said, and this is what I said, so forgive me for saying it. I said, the only thing I know about Twitter is President Trump is banned from it. That's it. At that time. That's the only thing I know about it. They said, you're not on? I said, no, I'm not on. They said, you have to get on. I said, why? They said, because people want to know about SBA. I said, nobody wants to know about SBA. He said, oh my God, Bruce, everybody wants to know about SBA. He said, I'm going to call you up. We're going to set you up, and and this is a true story. And so he calls me up the next day. He sets me up. We come up with this handle at SBA B Marks. And he says, okay, you got to start tweeting. And I literally go, well, how do you do that? And he says, all right, go on here. And I said, oh, I ran out of characters. He said, there's a little blue button on the bottom with a plus. I mean, I literally did. I mean, this is true story. And I tweeted, and then I got a couple of ding dings. I'm like, hey, that's pretty cool. I got 5 followers, you know, like this is pretty cool. And a couple of months later, I had maybe 100 followers at the time. I'd gotten up on a Saturday morning at 6:45, and I was aggravated. I had lost a $5 million deal in closing. And at 6:45 in the morning, no thought process, whatever, got on Twitter and just said, here's the story.
Yeah.
Just putting it out there. Hopefully this will save somebody from experiencing this and going through what this borrower just went through. I said hit, reply, boom. And I go back to bed. It's now like 5 or 10 after 7 on a Saturday morning. My wife's lying in bed beside me. And all of a sudden, ding, 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 ding. She says, I think your phone is broken. I go, I don't even know what that is. Like, what's going on with my phone? And I look, and yeah, exactly, literally. And my phone blew up. I ended up with over 500 followers that day. And I said, wow, this is really interesting. People must want to hear this and hear these stories. So I titled it War Stories Saturday and started tweeting on Saturdays, good stories, bad stories, but it's 100% SBA related, 100% factual, and real things to be impactful for others. I don't post anything about me. It's not about me. It's not the value driver of my account. It's to provide knowledge and help other prospects who are looking to acquire a business, and what they have to deal with. And it's just, and I love the comments to your point where people will post and go, nice story, Bruce, if it was only real. Like,
oh,
I'm like,
yeah.
oh,
yeah.
I'm sorry. Whether you believe it or not, it's real. Like, I can't help that. And so War Story Saturday was born, and I get the majority of my business from folks on the X platform.
That's incredible.
It is. It's amazing to me, but it's just, people find it. They know it's real. They know the basis of trying to be impactful. And Wes, it's really the reason that I continue to do what it is I do every day. Sure, we have a responsibility. We've gone through many years, a lot of experience. You want to give that back. You want to make sure that this next generation can, you mentioned Silver Tsunami, right? Take over these sellers who have been owning their business, running it for 32 years, now want to retire and want to have a legacy and leave their business to somebody.
So that whole Twitter following started from two guys that were like, "Oh, you got to get on there. Like, Twitter needs you."
100, and I give
up.
Johannes and Bennett all the credit all the time, because they were the ones who got me on Twitter.
We talked earlier about obviously the number of buyers that you're dealing with that are first-time buyers. I have recently been sort of, in the last year or two, turned on to this whole ecosystem of entrepreneurship through acquisition, search funders, whatever you'd like to call them. And it's a really neat thing to see such a large ecosystem of buyers who are out there looking to acquire, in many cases, their first business, especially with this silver tsunami, right? So many boomers. Now, I read, I think now the number is 12,000 people in the U.S. turning 65 every day. Right?
Wow.
12,000 up from 10. Just back when we were doing the CMMA certification, I think they said it was 10,000. Now it's 12 a day as the boomers retire. I get contacted by them all the time, as I know that you do too.
Sure.
I'd be curious in, the opportunity now, what advice would you give these aspiring entrepreneurs seeking to grow via acquisition as the market becomes more competitive, right? There's more buyers out there looking for deals and sourcing deals. And is there anything that comes to mind that you think, and through your eyes, that might be helpful to these,
Yeah. It's a great point. And I get that question a lot, because if a business broker is listing a business for sale on BizBuySell or with Como or however, all the other platforms out there, how do you separate yourself? Because people have to understand that the broker's responsibility is to vet the people that he puts
Yeah.
before the seller. Because if he puts before the seller this person and it doesn't work out, and then he puts this person and it doesn't work out, and this person,
Yeah.
it doesn't work, eventually the seller's going to say, now wait a minute, right?
Yeah.
But I'm sure you've seen that. So a lot of times borrower prospects will call me up and say, oh, can you give me a letter of an interest to lend, or a pre-qual letter,
right.
or something that sets me apart? And there's so many deals that they're looking at, because there's just, to your point, there's 12,000 people retiring a day. Not all of them are business owners, but certainly a percentage of them are.
Sure.
But multiply that by 5 times a week.
Yeah.
Times 4 weeks, right? That's a lot, right?
Yeah.
So what I tell buyers is you have to separate yourself. You have to separate yourself to the business broker to get in front of that seller. Because a lot of times business brokers are saying, well, you have to submit an LOI before we'll release a lot of the information. How do you submit an LOI without a balance sheet? Or how do you submit an LOI without knowing or getting a chance to meet the seller? So, like, what can you do? To me, you do some research about that business. You do research what makes that business unique. You provide what you can bring to the table and why you're different than the next guy. I know we're going to talk about mentors a little bit, but one of my mentors had specifically said this to me: Bruce, if there's 5 guys just like you against the wall, and this borrower has got to pick between the 5 of you, why does he choose you? And if you don't know, how will he?
Yeah.
And I think about that all the time, because when prospects call me up and say, give me a letter that gives me some support so I can give it to a broker to show them that I've got potential lending partner, I always think to myself, you're missing the boat, because this letter is just a standard, hey, I'll lend you money if you find the right business, if it's got the right service, if it's debt service, if it's in the right industry, if the stars align, if what good is that? So the advice I would give them is learn about that business, learn how you can separate yourself from the next buyer, what you bring to the table, and why that seller should choose you, not just your LOI, if that makes sense.
Yeah, no, that's great. I love that, and I would not have guessed that answer, but it makes total sense, especially for the businesses that are out there that are really solid. Like they're going to have a lot of interest, right? So
yes.
You're going to need to differentiate yourself, especially if your sales pitch is that I'm going to pay you more than anybody else. If that's not your pitch, which I wouldn't think it would aspire for any buyer to be the top price, right? Because the business has to make sense and it has to cash flow. And so if you want to
100%.
differentiate in some sort of meaningful way that doesn't involve throwing money at it, then that's great. Do you have any sort of, on that same sort of train of thought, do you have any sort of sense for what your clients are having the most successful in terms of deal sourcing, finding deals? Is it through third-party sites like Biz Buy Sell? Is it through business broker sites? Is it networking, word of mouth, letter writing, cold emails? Because I can tell you on my side, I've worked on it a little bit on behalf of a client, and it's hard. There's ways to pull up. We put together some proprietary methods where we were able to turn up some leads of sort of off-market opportunities, but most of the ones that we turned up were, once you peeled away the onion, there wasn't much there, for whatever reason. It wasn't a very viable business that it had no scalability to it whatsoever. It wasn't a lot of businesses you find in industries where I would call it a hobby or a passion type of business, like apparel, right? Mm-hmm. I love clothes. I would love to own a successful clothing business, but so are so many other people. And we turned up a lot of apparel businesses that we called or we emailed and got on the phone, it was like, they're like, yeah, we need growth capital because we don't have any more.
That's right.
That's right. We can't grow from the cash flow that we have. So
that's right.
Just kind of curious as to what you're kind of seeing out there and that is successful deal sourcing methods. Because I think, just to close out my question, is that I think that any successful buyer in the industry, whether it's an individual, sort of owner-operator buyer, ETA, entrepreneur, whatever, or an institutional buyer, they would tell you they have to look at a lot of deals and kiss a lot of frogs before they land on one, right? So it's a numbers game. Like, what's the best way to play that numbers game, you think?
Have you ever heard of the terminology pocket listing?
Yes.
Right? So that's where a listing is, a broker has a listing, it hasn't quite come out yet, it's in his pocket, and you fortunately get that call that says, hey, I've got a really good business for sale. That's where you separate your sign. So I think it's, you can throw the darts against the wall, Wes, and hope they stick.
Yeah.
And that's chance, right? So my thought process is, well, you've got to hone in. You can't just 10 channels. It just, right? Because then you're busy doing nothing, right? It's just like all of it. So in my opinion, and what I have done that's worked for me successful in acquiring businesses, is aligning myself with one business broker. Like in Florida, as you know, we talked about some business brokers that we both know. We have the Florida business brokers, right? And they will share with one another. So we've got a unique state because brokers will share commissions with brokers. A lot of other states are not like that. So if a listing goes on the BBF, Business Brokers of Florida listing, and I've aligned with one broker, he's going to see all those listings.
Yeah.
And he's going to say, hey, Bruce, I think this meets your criteria.
Yeah, that's great.
Do you have any interest in looking at this business? I know the business broker. I'll get the SIM. I'll get the information. Let me know if you're interested. So it's that time. It's like anything else. It's a relationship. Why am I here today? Why am I doing this? Because I know you. We have a relationship. We met at CM&AA 10 years ago, right?
Yeah.
We've chatted about deals. It's relationship. And so when you boil it down, what are you doing as a potential future entrepreneur? You're making the relationship with that business broker. You're making the relationship with the seller, right? You're making relationship with your deal team, your lender, right? It's all about building that credibility. So in deal sourcing for me, it's like, just like I'm talking about setting yourself apart and doing the things that you need to do, I think it goes for the same way in deal sourcing. It's hard to run a proprietary, then do like if you walked into a business brokerage firm, how does the business broker get those leads? How does he get this business for sale? Do you know? I'm going to tell you. They buy a list. Here's a list of the 50, let's say I concentrate in light manufacturing. Here's the list of 50 light manufacturing businesses from Dade, Broward, West Palm Beach, Jupiter, blah, blah, blah. And I'm going to say, dear Mr. Shelton, I know you've been in business for 22 years. I've got 10 people who are interested in buying your business. Should you decide to sell, I would, right? And all of a sudden you get that and you go, wow, I'm thinking about it. Let me give this guy a call.
Yeah.
That's how they do it. Now, can a prospect who's looking to buy a business do that? Sure. Why not?
Why not?
Right? You have a lot of people that are maybe they're looking to acquire a business, but maybe they're a little bit more older and they've accumulated a little bit of money. What do? They hire interns to go out and start dialing for dollars. I mean, you know this. I'm not telling you anything you don't know. It's just all the same stuff. So it's like, which one works best for you? You can't, I guess you can do all of them if you want, But for me, and what I have found successful is establishing a relationship, working with that relationship, getting deal flow. There's always going to be deal flow.
Yeah, right.
Why? Because
it
12,000
right.
a day.
Yeah, it changes.
It changes, right? Like you could look this week and it could be different, and it will be different.
Mm-hmm.
You have Axial, which is a nice platform, right? You've got, Biz Buy Sell. You've got Withcomb. I mean, you've got several Bowfly. I mean, you've got several platforms to look at the businesses, and I think it matters, to be truthful with you, the size business that you're looking for. So if I'm an entrepreneur and I want to buy 2 or 3 or 4 franchises, maybe I start calling the franchisor and saying, hey, do you have any franchisees for sale? Yeah. How do I get in touch with them? Visiting the franchise. Hey, do you know anybody that's selling, a crumble cookie or something, that's right? Like a fast moving franchise or something like that. But if you're trying to buy a $4 million EBITDA business, that's a lot different than going to a business broker.
Sure.
Make sense?
Yeah, sure. I try to tell when I get inquiries, because we're mainly sell-side representation, so we get buyers all the time, whether they're ETA guys and gals or they're private equity or whatever. A lot of times they want to get on the phone with me and talk. Hey, would love to hear what's in your pipeline and talk. And I always say, thank you for the inquiry. I get a lot of these, and there's no way I can get on a 30-minute chit chat with all of you, because then I would just never get any work done. But the best way is to stay in front of me, because I need buyers too, sellers, right?
Right.
Is I say, make it easy for me to stay in front of me. Send me quarterly, send me an email, either with your one pager, but even better, embed your criteria into the email in text. So I don't have to even open anything. Hey Wes, it's Bruce again. Just checking to see if you got anything. As a reminder, I'm looking for industrial services, light manufacturing, Southeast region, that's 2 to 5 million EBITDA. And I'll look at it every time. I'm going to look at it because it only takes me 15 seconds to read it. I go, oh, that's right. Actually, I'm talking to a guy right now.
There you go.
And a lot of times they haven't got me all the information yet so that I can give them a value range so that they can hire me. But now you're in front of the line because, we've exchanged some emails, and maybe did speak about a call a year ago or about another deal and it didn't work out, but I kind of remember you. And so that's the one thing I say, make it really easy for me to stay in front of me.
Exactly.
And
imagine now
people
adding
seem to appreciate that
this guy adds something that absolutely sticks out. I have been in the defense industry for 15 years. I am looking to buy a defense contractor or something. You're going to immediately go, wow.
This guy knows the business.
Right? Like he has just made a statement that now resonates the next time you see or when you see, right? You're going to go, oh, you know what? I think I have a client that might, right? It's those kind of things. It's if you're thrown up against the wall, why are they choosing you?
And you made the right term that you used was pocket listing, because we do have people, I talk to people every day. Normally the process is we get hired exclusively and we go run a process. But not everybody wants that, which is hence why pocket listings exist, right? Yeah, Wes, I do want to sell my house. I just don't want people running in and out of here.
That's right.
If the price is decent or good, the price is good, I'm ready. But if not, I just don't need to. But I'm happy to protect you for a fee if you get it. And so we get some of those people where I talk to them, and most of them are referred to me. Yeah, 10 million, I'm a seller, but we may go back and forth a few times on a retainer or whatever. But if I have somebody that's in that space, and most of the time the sellers are willing to protect me.
Sure.
Yeah, I'm happy to make that introduction. And by the way, I can stay in and help, or I can stand back and let you guys work it out with your attorneys. There's no ego. You just tell me how you want to work. And so for somebody that stays in front of me at the right time,
that's right,
they might get that intro where they otherwise, might not have. So
good thing we're aligned.
Yeah, I think so. But certainly if you wanted to, there was a great podcast that I listened to the other day, and I'm trying to remember exactly
Was it this
what
one?
you wanted. Oh, it was. I think it was. Yeah. I mean, it wasn't like a champion, but it was okay. I think it was actually called My First Million or something like that. And it was this gal who came on, pretty young gal, and she bought some egg crate company, which sounds like the most, basic and simple business ever. But she came on at the beginning of the show, and she was very direct, and I just loved it. But she basically was like, people have been calling me for a long time asking the whole story. And she's like, I'm not I'm very private. But I thought maybe I'll just come on the podcast this one time and I'll tell the story and I'll just be done with it and people will leave me alone. And she told the story, but much like what you said earlier, she got a couple of interns from the local university, and I forget exactly where she was. I want to say she was in the Midwest or something. And she just had them just pound the phones.
Yes.
And ultimately what she found was this business that she felt like had a really solid foundation, but then also she could grow it, and she had an
That's
avenue,
the bet
channel
we
for
talked
that,
about, right?
Right, 100%. And she, but also a seller that was reasonable and willing to work with her on seller note structure and getting it easy to get into and get it closed. And I just love that. But the point was, in her case, she got a couple of interns that were hungry to learn the process.
Yep.
And she just hustled. It was just a great story. But so just moving on, I think this is just another one of the check boxes that I talk about. Everybody is obviously talking about AI, and none of us have a crystal ball to know exactly what the world's going to look like in that sense in 5 or 10 or 20 years from now. We see some of the manifestations of that, but new tools are coming out every day and getting better. How do you see that potentially impacting the world that you live in and the business world in general, SBA lending, et cetera, et cetera? How do you see that? Like, what comes to mind?
So, I made my first SBA loan years and years and years ago. And I look at today and I look at what's changed. What's changed in the several decades from when I first made my first SBA loan, other than the size increasing? Mm-hmm. Not much. Still got to have an application. Well, that application was done on a typewriter. Now it's done on the computer, right? But it's still an application. Still had to underwrite the deal. Still got to underwrite the deal. Still got to have a credit analysis. Still got to have a credit analysis. Still got to meet all the bank criteria. Still got to meet all the bank criteria.
He who has the gold.
So what was years and years and years ago, maybe it's easier to do the application today. Maybe you can throw the numbers in a spreadsheet and it pops it out. Makes it a little bit easier. But what's changed? Not a lot, to be truthful with you. Mm-hmm. So do I necessarily know what AI is going to do to this industry? Do I know what computer technology? I think as long as it's people wanting to borrow money, and unless they try to put on like these credit scoring system. Oh, if you meet this certain score, you can get a loan of XYZ, or if you apply for a credit card, if you have a credit score of blah, blah, blah. Okay, great. I had a great credit score when I applied for the credit card, but then I used it, maxed it up, and now I can't pay it. Would AI have caught that? I don't know. It's human behavior. So I don't really see it. It might help the process, but you're still going to need all the integral parts of it to get to the decision to whether you lend a guy $5 or $10 million. And remember something, as a loan officer, Wes, my very first job is not to make a loan. My very first job is to protect the assets of my bank's shareholders and depositors. That's their money.
Sure.
So if I make the wrong bet, it affects them. Can't do that a lot. Yeah. Will AI be able to tell us who we should lend to and not to? I don't know. Not me, not my call. I don't know.
Yeah.
That make sense? I don't know. It's just
yeah,
kind of the way I look at it.
Well, I don't. I guess if I would think that there's always going to be a human component to what it is you do, and I'm not sure that I was expecting any particular answer, but I do think that it's possible that it could make things move a little quicker, more efficiently, maybe review of documents, maybe. For me, it's helpful for a lot of the front end stuff where it's, hey Wes, what do you think I'm worth? You know, what do you think you could sell the business for? Where I can kind of run it through some filters and AI filters that I built, where I don't have to sit down and read.
But my point is the guy says to you, what is this worth? You run it through the AI filters. It tells you what the business is worth today. It takes you 6 months to sell. In those 6 months, the seller has taken his eye off the ball. EBITDA has dropped by $350,000. Is that business now worth the same what it was 6 months ago?
No, absolutely not.
Absolutely not. Will AI be able to detect what this guy is going to do 6 months from now if he takes his eye? How many times have you seen that example? How many?
An eye off the ball, kind of, yeah.
A lot, right?
Degradation of EBITDA.
A lot.
Yeah, sure.
A lot. It's human nature. Oh, finally sold my business.
Yeah.
I can now go do, and then we get the numbers. I had a transaction 2 weeks ago. Wasn't last week, 2 weeks ago. Okay, they're getting ready. Deal's under LOI. They go in, they do the Q of E. The last 3 months, deal's off.
I think
that's real.
Some of that is, it can be eye off the ball, but I also think a lot of times it could be a seller who's bogged down during the diligence process, right? I mean, we see it a lot of times where the seller just doesn't.
Yeah, but they tell you the seller's not responsible. He only works 3 days a week. Mm-hmm. You know, he's not intimately involved in the day-to-day operations of the business. Now he's tied up with diligence and sales start to go like this. Really? Mm. That's where I'm going to come back to you and go, okay, what side of the mouth are you talking from? Left or the right, my friend?
Yeah.
Right? That's real.
When you talk about Q of E, I've been involved in deals with SBA financing involved where there's a Q of E and times where it's just been a business appraisal. Is that a bank thing that?
So two totally different things, by the way.
Well, yeah, that's why I'm saying.
Right. So Q of E, quality of earnings, is basically an audit of the income statement. Right. They don't do much on the balance sheet side. Only when you start to ask the Q of E provider to do a deep dive on the working capital adequacy. And then the business valuation, totally separate, third-party, independent business valuator, going in and saying, based upon these numbers, this is what we feel the business is worth to an unemotional buyer or an unemotional seller, which is always Bruce, a fun part.
What I'm trying to say is I've been involved in a transaction where only a business valuation is done and not a Q of E, which was surprising to me because I would think that, like you said, they're two totally different things, and the valuation is much more sort of high level to me and less invasive than a quality of earnings, which is counting every bean almost. So I'm just curious if you see that, or if that's a discretionary thing, or that's a bank thing, or.
Great question, and I'll answer it for you. So a Q of E is done often when a buyer has several minority owners that he needs to raise money from. And they want to see that what they're investing in is really what this business is returning.
Mm-hmm. Sure.
Right? If it's just me and I'm buying a business that I know a little about and I can look at the numbers and I can get comfortable, maybe I don't need a Q of E. Mm-hmm. A business valuation is always going to be required. That is required.
Right.
And a lot of times, I'm in a transaction right now where I have one partner trying to buy out the other partner. So let's say we're partners and you say to me, hey, Bruce, you're getting old, or you are old, and I'm young and handsome and good looking and run this great podcast and I want to buy your business. Okay, I want 10 million. Well, Bruce, I only want to give you 6. So we're going to do a business valuation to determine what the price of that business is. And by the way, you agree to buy and I agree to sell, right? Based upon what that number is. Nothing to do with a QOV. And you wouldn't order a QOV because you're in the business and you know the business, right? So that's the difference. A QOV is done most of the time for somebody who's buying a business where they have investors involved who want to basically get a confirmation of what they are buying, rather than me as the person trying to sell you, hey, will you invest in my business? It's throwing off $1.3 million in EBITDA. Okay, well, let me see that it's throwing off $1.3 million.
Yeah.
Right. Yeah. So that's really the difference between the two.
Gotcha. Okay. And so your bank typically,
we like to see QOV. We like to see them. SBA requires a third-party independent business valuation to be done. That's a requirement.
Gotcha. Okay.
Especially on the deal sizes I work on. But the majority of the people that we do work with, I would tell you that 90% of my deals, QOV is getting done. Yeah. And the 10% that aren't are like in a situation where it's maybe a partner buyout or a person that's working for the business and now wants to buy the seller, as an employee. It's kind of where they don't really need to do it and it doesn't make sense and it's not necessary.
A little overkill.
But 90% of the times a QOV is being done to satisfy that half, and then a business valuation is being done because that's a requirement.
Right. Okay. All right. So what are some non-financial factors you would say, such as a management team or industry dynamics, that significantly influence the decisions that you make? So how do you, obviously numbers and QOVs and appraisals they're binary, right? They're numbers.
Yep.
There are so many other factors that look at valuation. I'm curious as to how you guys look at that, especially in the light of, I would imagine, you lend to a number of different industries, right? So it's not like we're just manufacturing guys or what have you. So how do you really get comfortable with those things, and what are you really looking for?
Yeah. So for me, and when I say for me, I literally mean me, not the bank. For me, I try to stay away from want businesses and lend to need business because of the word that I used prior, which was sustainability. So when I look at a business, if I feel it's a discretionary purchase with a want attached to it, I'm gonna most likely suggest that somebody go to a different lender. It's just not.
Yeah.
So I'll give you an example, and this is just an example for me. Don't want to be taken incorrectly out of context. I had a borrower several years ago call me up and say, Bruce, I'm under LOI to buy a light manufacturing business. Okay. Do you do light manufacturing? Yes. Great. It comes with the real estate. So I'm buying the business for $4.5 million, $2 million in real estate, $2.5 million for the business. So good collateral. The deal cash flows, tells me why he really likes the business. So I said to him, okay, got it. What do they manufacture? And he said to me, they manufacture kayaks. Now for me, that is a want. No one needs a kayak, in all fairness.
I kayaked to work this morning. I mean, you
awesome.
Didn't do that?
Awesome.
Just right up the New River. And
right, that's
took
awesome.
My helmet off. And
but you probably could have taken your bike if you didn't have a kayak. Anyway.
Or on these
maybe
roads.
One of these nice cars in our background. I got a different way to get here, Wes. And it's a want and it's discretionary. So I said to him, it's not something that I would look to finance because it's, in my mind, it doesn't align with the terminology of sustainable. And I'm not saying it's not a good business. I'm just saying, for me, that's a definite non-starter. For me, a definite non-starter is retail. I will not lend on retail. Just will not lend on
what?
It. Retail.
Retail, sorry.
Retail business. Yeah. It just doesn't align with the way that I buy, the way that I view what's happening in the world today. It's just a very, it's just a segment that is, so that's why I was saying, it doesn't mean it's not SBA eligible, or it doesn't mean you can't get a loan, going back to my prior comments. It just means I'm not the right lender for you.
Yeah.
Right? So that, the business, for me, I put it into three. So we'll give you three tranches to make things nice. Number one for me is the business and the business model. So as a lender, it always starts with that. Why is the business in business? Why will it be in business, arguably 3, 5, 7, 10 years from now? How do they generate revenue? Why do they generate revenue? Is it a mature industry? Is it a declining industry? Mm-hmm. What outside influences could help derail the business or help grow the business? Now, would it be impacted by tariffs? Would it be impacted by supply chain? Would it be impacted by what? All of those things. That's my initial conversation, not cash flow. Because if I can't get comfortable with the premise of the business and the business model, I'll never get to the cash flow. So for me, it starts with a really granular deep dive into the business itself, and can I get my arms around the business? So people say to me, well, Bruce, what's your favorite business then? What do you love to lend on? And so I'll give you an example, and I will say to you, something like roofing. Why? Because Wes comes home tonight, and he walks in, and he looks in the corner of his living room, and he sees drip, 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 drip. And your wife says, hey, call the roofer, get him out here. It's 11 o'clock at night. I don't care, right? And it doesn't matter whether you can afford it or you can't, or you want it or you don't. You gotta, right?
And I'm not fixing it.
And you're not fixing it because you don't have the skill set to do it.
I'm not saying I'm not handy, Bruce. And I'm not going to say it on the show, but I'm probably not.
No,
it's more of a heights problem.
I could. Yeah. Well, you say, I make a lot of money and I'm going to let the company that specializes in doing what they do.
That's what I say.
Do it.
Yeah.
Right? Because that's what they do best. You do what you do best. Right? So you're going to leave it to the experts to do it. You might be able to do it, but you're going to leave it to the experts to do it. That, to me, is super sustainable, because doesn't make a difference whether you can or you can't afford it, or you want it or you don't. You have to. You have to.
Yeah. Plumbing, electrical. It's amazing how popular the trades are, and
because of that thought process, I believe.
Recession proof,
right?
For the most part.
So the second, let me get to the second and third quickly, so I can make sure I can keep in compliance with. So the second one for me is then the buyer. Who's the buyer? Mm-hmm. What skill set does the seller have that you need to have to make this business not just to where we say,
right,
but to have that? What are you bringing to the table that is going to convince me that you're the right guy to lend to, that you are the person that I should lend $5 or $6 million to of our shareholder depositors' money to make this venture work? So we're going to get very deep dive into your background. What is it you've been doing? I'll give you an example. I remember it well. It was a person that I had a relationship. He called me up and he said, Bruce, my son just graduated Kellogg Booth, and he is under LOI to buy a plumbing business. Oh, okay. So want to jump on the call. I'm going to be supporting him, and I'm going to be making the majority of the equity check. Mm-hmm. And my plan is to put in 25%. The seller's going to hold, so we only want 65% leverage. So I got on the phone with the young man and his dad, who I knew well. And I said to him, so you just graduated school? Yes, I did. Congratulations. Tell me a little bit about your management. What do you mean? Well, how many people you've managed, how long you've been doing it.
I took a management course.
Exactly.
Right?
Right.
Probably something like that.
So I turned to the dad and I said, sorry, I know you, and I know we're friends, but I am not the lender on this deal. I can suggest a few others. He's like, Bruce, I don't understand. I said, what you don't understand is I can't lend to your son who's buying a business, who's now going to have to manage 22 veterans in terms of age, what they've done, experience, right? Long time in the field, who know 10 times, 100 times, and he's not, it's not going to work. It's not going to work. It doesn't matter whether I've got cash flow or I'm buying a phenomenal business. He doesn't have the skill set.
Somewhere for a little bit.
Right. Yeah. I remember a good friend of mine, good acquaintance of mine, said he was in the restaurant business. He said, you know what? I want my son to come in, but he's going to go up to New York and he's going to learn the business and he's going to learn the trade and he's going to spend 5 to 7 years under somebody else's belt before he comes back and starts working with me. And I thought that was brilliant.
Yeah.
Right? So it matters the business, the borrower, and the third is the cash flow. The deal's got to make sense. The numbers have to work. But you never get to 3, Wes.
If 1 and 2 don't work.
Yeah. It's kind of like a stepladder. You can't just jump on the 3rd rung of the ladder and go, wow.
Yeah.
It doesn't work that way.
Yeah. No, that makes total sense. And just kind of graduating a little bit from the ins and outs of deals and the underwriting process and all that. We alluded to it a little bit before, but this show, we like to talk a lot about mentors. And I know you've done some mentoring yourself and you're working with buyers. But what about being mentored yourself? I mean, you've been at this for 35 years. Have there been mentors in your life and in your business life that have helped you get to where you are today?
Yeah. My number one mentor was my dad, without a doubt. He owned his own business. I started working for him at 13 years old. Taught me a lot about business, taught me a lot about the proper way to do things, and would always talk about transactions the way I was looking at them, getting his input the way he would look at them. Because I believe a mentor is somebody you have to fully trust that what they're telling you is something that you can grasp and that you can take to heart. And to this day, I am constantly saying quotes, reminding myself of the things that he taught me, the lessons that he instilled in me. Another great mentor of mine is somebody that you actually know, a gentleman named Mike Adhikari. And I'll remind you of Mike because he was the teacher at our SEMA class. And I owe a great deal of my success to Mike because when I wanted to get into moving away from what we call Main Street small business lending and moving upstream to come into the lower middle market, Mike was instrumental in my success in helping me do that and helping me to get to where I am. And he is, in my mind, the sharpest guy and the most experienced guy when it comes to M&A that I've ever met. And if I need something, that trust in it, I could call him and I know he will be there for me no matter what. So he's been a phenomenal mentor for me, and just an unbelievable individual as well. Another mentor, and probably the third mentor that I would mention, is a guy named Nick Nanton. And Nick is just a phenomenal individual. He lives in Orlando. I met him 10 years ago. I was attending a conference and he was the guest speaker. And he wrote a book called Celebrity Branding You. And the premise of the book is that if you become a celebrity, people will come to you versus you going to them. Because everybody wants to deal with a celebrity. Everyone, you know, it's kind of like this. If you are playing baseball and you hurt your hand and you start talking to friends, everybody's going to tell you, this guy is the best hand surgeon. And you're going to, he's the hand surgeon for the Marlins. He's the best guy out there. He's done this surgery. He worked with this. And everybody is advertising for him. You haven't met him. You don't know him. But everybody is telling you how fabulous this guy is, right? Think about it. So the premise of Celebrity Branding You is, what do you have to do to become a celebrity? What do you have to do to brand yourself? What do you have to do so that instead of dialing for dollars, people will call you? And I got the opportunity to work with him. And I would say probably single-handedly, he mentored me in a way to show me how to get exactly where I am today. He's an incredible person. He's an Emmy Award.
What was his line of work, his profession?
He was an attorney, and now he is an Emmy Award-winning producer, writer, business owner, entrepreneur, everything.
Wow.
So he's doing movies, he's collaborating, he's written a number of books. If you Googled him, the first 20 pages of Google are all about Nick Nanton. He's just an incredible person as a person who cares about what happens in this world.
So you had 3 mentors. You mentioned some quotes that you think of your dad every day. Do you have any that you can share?
Yeah, and it came on Monday. I was supposed to have a loan closing on Monday. And the notaries were all set. Everything was done. Docs, everything prepared. And Monday morning, got an email from the borrower, I'm walking from the deal. I'm not closing it. And he walked. And my dad would always tell me, until it's in your hand, you've got nothing. And when it happened, I thought of that. Because if I was counting on that loan to close, and the bank was counting on that asset to hit the books, until it did, just that happening. And when it happened, I immediately thought of my dad, and I just looked up into the heavens and said, yep, wasn't here, and it didn't happen. And it's things like that that you remember. Another one that he taught me, which was such a super valuable lesson, is, you know, when we were growing up, I don't know if but when
I did grow up though, by the way.
Yeah, you did grow up.
We share that.
But we used to take cards with a little clip, and we used to put it in the spokes. So it'd go, right? And make noise in the spokes. My dad had taught me a very, very, very valuable lesson when I was a young man. And he said, Bruce, in order for that wheel to turn, all the spokes have to work. If 3 or 4 of those spokes are broken, the wheel's not going to turn. And that's life, and that's relationships. And he would tell me, never look down on a person. For example, never look down on the person who comes around on Wednesdays and Saturdays in your community and picks up the garbage. Because if he doesn't do it, you would.
Problem.
Never look down on the guy that's cutting your grass, because if he isn't, that will be you. And it takes everybody to make a community work.
Yeah, right.
And that relates to what we do, because it's your deal team. The client can find a deal, maybe, but if he doesn't have the right M&A advisor, if he doesn't have the right attorney, if he doesn't have the right lender, if he's not working with the right seller, like that deal team in what we do every day, Wes, super important to make the ecosystem, we talk about the ecosystem, working.
Makes a lot of sense. We talk about, at the end of the show, we do a couple of rapid fire questions. And so we're on the topic of mentors and quotes. If you had a billboard that could say anything, what would your billboard say?
To be successful, specialize, become an expert in that specialty, and then let the marketplace know what it is you do and what you don't do.
Might have to be a Excel billboard, but I think those are good words.
Yeah.
That's what you've done 35 years.
It has.
Right?
The other thing is, I would tell you that the way that I conduct myself, and I hope anybody that's listening to this podcast, and everybody that's listening to this podcast, if they take away these few words, I'll be thrilled. And that's, let the consequences dictate the action. If you don't want the consequences, don't do the action.
That one might even fit better on the billboard. So
I think so.
I'm not sure I've heard that one before. That's pretty good. That's why we asked those
taught
questions.
it to my kids when they were young. I've instilled it into my grandkids, and I say it to anybody who will at least listen to what I have to say. Yeah. And hopefully when they hear it, it stops somewhere in between and doesn't go out the other ear. But it's, let the consequences dictate the action.
Books that you have read that have influenced you. Pick one or two.
Celebrity Branding You.
Yeah.
Bar down. The number one book for me.
Yeah.
The Millionaire Next Door.
Yeah. It's on my shelf.
Right. Super.
It's been a while.
Why bad things happen to good people. A book by Rabbi Kirshner. Why bad things happen to good people. Puts life into perspective. Yeah. I like to think about life, and as I was telling Matt earlier, right? What I said, you know how you've heard you only die once, and I mean you only live once, and my saying was you only die once, you live every day. To me, that's a valuable, every day. I get up in the morning and I'm looking to enjoy life and enjoying each and every day. Being impactful and making a difference in as many people's lives as I can at this point in my life.
Yeah. Well, how is it that you impact lives? Is it, you feel like it's just more everyday interactions, and because there's a lot of positivity that comes from you, so
yes,
I can see how the people that you work with on a daily basis, you just bring in good energy and
I get really fulfilled when I get a DM on Twitter that says, Bruce, I've never met you, I've never spoken to you, but I want to tell you how you've impacted me and how you helped me buy a business.
Well, that's great.
And it is absolutely fun. I had a call from a borrower the other day, and he said to me, Bruce, I wanted to let you know before we started that I spoke with 3 other folks in the lending community, and when I told them about what it is that I intended to do and what I was looking to accomplish, every one of them said, you need to speak with Bruce Marks.
Wow.
It's comments like that that I know that what I'm doing through social media, podcast, how many times people will call me and say, I heard you on this podcast. I saw you speak at Wharton. I saw you on this podcast. I saw you on YouTube. Because it's those messages that are getting out to the folks that are looking to acquire a business that I am impacting. And I look at the number of transactions that I've done, Wes, And I'm very proud to say that I've had a little piece of their success.
Yeah. You played a part in it. That's meaningful. That is a word that I like to use a lot recently and think about and ponder is meaningful. What am I doing?
100%.
Right. What am I doing that's meaningful with my family, in my workplace, and
when you're
just everyday life,
impactful,
walking down the street?
When you're impactful, you're very well meaningful.
Yeah. Yeah. Bruce, thanks for coming on. It was a pleasure. I think that you brought it today.
Thanks.
So much knowledge and experience to share that's relevant to our audience, and really appreciate you spending the time to come and meet with me. And obviously, I don't know when the last time I saw you was, but it may have been at the thing 10 years ago.
Could have been.
And
but, well,
many
we've done Zoom,
conversations.
calls and stuff, right? Like,
Yeah,
exactly.
so let's do a deal
Well,
soon.
let's not wait 10 more years, my friend.
Let's do a deal soon and
Yeah.
play some tennis
I would love to.
somehow.
Yes, absolutely.
Thanks for coming.
Thanks, my friend. Thanks for having me.
Sure.